We'll now talk about fixed income valuation. Here is the basic point. One way of coming up with the bond price is to take the present value of all future cash flows using the market discount rate. And this is something that you've seen in financial reporting and analysis. So let's say that when the bond is issued, the market discount rate is 8%. So I'm just picking a number. Market discount rate, this is the rate of return required by investors given the risk of the bond. The market discount rate is also called the required yield. It's also called the required rate of return. This concept here again is a repeat. You've seen this in FRA, and I'm almost certain that in some form this will show up on your exam. Let's say a company issues a bond where the coupon rate is 12%. The coupon rate is greater than the market discount rate of 8%. This is a discount bond. Actually, I got that wrong. So let's say that a company issues a bond where the coupon rate is 4%. So the coupon rate is less than the market rate. In this situation, the bond issued is called a discount bond. The value of the bond will be less than par value. If the par value is 100, then the bond is going to be issued at less than 100. So in this scenario, this is 100 and this is something like 70. So the bond is issued at a discount. Now, over the life of the bond, it will eventually go up, and at maturity, it will be worth 100. If the coupon rate is greater than the market discount rate, so assuming the market rate is still 8%, but the coupon rate is 12% on another bond, then that bond will be a premium bond. So that will be issued at a price that is greater than 100. If the coupon rate is equal to the market discount rate, then we say that this is a par bond. A few terms now. The yield to maturity, or the YTM, is the internal rate of return on the cash flows. It is the uniform interest rate such that when the future cash flows are discounted at that rate, the sum of the present values equals the price of the bond. This is just the definition of IRR. It is the implied market discount rate. When we talk about YTM, there are three assumptions being made. Number one, the investor will hold till maturity. Number two, the issuer will make all payments. In other words, there will be no default. And finally, the investor reinvests all the intermediate cash flow at the YTM rate. And again, this assumption at least is the IRR assumption. Relationships between bond price and bond characteristics, and this material I think is very testable. Inverse effect. A bond price is inversely related to the market discount rate. So if you take the bond price on the y-axis and the discount rate on the x-axis, then for a straight bond, you will have a graph like this. As the rate goes up, the price of the bond comes down. This point here will simply be the undiscounted cash flows associated with the bond. And then after that, as rate goes up, then obviously the price of the bond will come down. This is the inverse effect, because as rate goes up, the price comes down. Convexity effect. Notice that if you look at this curve from the origin, then the shape is convex. But more formally, here is what we can say. For the same coupon rate and time to maturity, the percentage price change is greater when the market discount rate goes down than when it goes up. So what does that mean? Let's say that you are at this point, and let's say at this point the rate is 8% and the price is 100. If the rate goes up by 1% from 8 to 9, then the drop in price is this much. On the other hand, if the rate goes down by the same amount, then the increase in price is more. So this is the convexity effect. Next point, coupon effect. For the same time to maturity, a lower coupon bond has a greater percentage price change than a higher coupon bond when their market discount rates change by the same amount. And I'll illustrate this through a simple example. Say you have bond D, which is a pure discount instrument. So it's a 10-year bond and no coupon payments, just a par value of 100 at maturity, and let's say that the discount rate is 10%. So you can calculate the present value. Then you have another bond called, let's say, bond B, which is a 10-year bond, but this has a 10% coupon. I'm not going to do the numbers here, but if you compare these two bonds, one with as low a coupon as you can get, which is 0 coupon, and the other with a 10% coupon, if interest rates change, let's say the interest rate goes up by 1%, then the impact on bond D, the percentage change in price of bond D, will be much more than the percentage change in price of bond B. So this is called the coupon effect. When the coupon rate is higher, the sensitivity to changes in interest rate becomes lower. Generally, for the same coupon rate, a longer term bond has a greater percentage price change than a shorter term bond, and their market discount rates, when their market discount rates change by the same amount. So this also is an important fact, saying that if you have two bonds, bond A is a 1-year bond, bond B is a 10-year bond, all else equal, when there is a change in interest rate, the price of bond B will be impacted more. All right, pricing bonds. We can use, pricing bonds. Spot rates are yields to maturity on 0 coupon bonds maturing at the date of each cash flow. Bond price or value determined using the spot rates is sometimes referred to as the bond's no arbitrage value. If a bond's price differs from its no arbitrage value, an arbitrage opportunity exists in the absence of transaction costs. Let me give you a simple scenario. Let's say that you have a 3-year bond, and let's say that this is an annual pay bond. So what's going on here? 0, 1, 2, 3. And let's say par value is equal to 100 and the coupon rate is 10%. So what is the cash flow? It's 10, 10 and 110. When we talk about pricing the bond using spot rates, what we do is the following. We need to get the 1-year spot rate, that is the rate on a 1-year 0 coupon bond, and this $10 will be discounted using the 1-year spot rate. The next 10 will be discounted using the 2-year spot, and this will be discounted using the 3-year spot. So this price of the bond then is simply the sum of the 3 numbers that you calculated, and that price is called the arbitrage-free price. If the bond price is anything other than what you calculate here, then it is possible to make an arbitrage profit. Next point, which again I think is quite testable, flat price, accrued interest and the full price. When a bond is between coupon payments, its price has 2 parts, the flat price and accrued interest. The sum of the parts is the full price, which is also called the invoice or dirty price. The flat price, which is the full price minus the accrued interest, is also called the quoted or clean price. So when you look at the price in the newspaper, then that is the quoted price or the clean price. If you buy the bond, the amount that you will actually pay is the full price. And the full price is also called invoice price or dirty price. Now let me illustrate this concept. Let's say that you have a particular bond and this is times 0, 1, 2, 3 and 4. So this is a 2-year bond and semi-annual payments. So say this is a bond with par value 100, coupon rate 10%. So what are the coupon payments here? They'll be 5, 5, 5 and 5. Now the point is this: if you buy the bond somewhere in the middle of the first period, so I'll just make the numbers quite simple here. So you buy the bond at this stage. The person who is selling you the bond should get some interest for holding the bond for half the period. So in fact, simplistically, if the next coupon is 5 and you are buying the bond here, you will get that 5. But the person who held the bond for the first half of this period really deserves half of this number. So that amount that he deserves is called the accrued interest. And the simplistic formula for accrued interest is small t over big T, where small t is this period in days and big T is the number of days in the full period. So this might be 180. So if we are using a 30-360 convention, then you have 360 in a year, and in 6 months you have 180. So in that scenario, big T is 180. And then if this is happening halfway through, then small t is going to be 90. So this is accrued interest. Now, how do we calculate the full price? The way we calculate the full price here is we actually come up with the present value of all future cash flows at this point, and then move this number forward by taking the price over here, and then we do 1 plus the interest rate, whatever the appropriate interest rate is. So 1 plus the interest rate raised to the power of this period in years. So if this is 90 days, then it would be raised to 90 over, actually this would be 90 over 180. So this would be the full price, and then what is the clean price? It would be the full price minus the accrued interest. Now this is a high level explanation. In the examples which are associated with this crash course, you will see this particular calculation in detail. And I also give you a shortcut in the examples. The shortcut in the examples is that if you want the clean price at a certain point, you can just use the calculator, and for this particular scenario on the calculator for n, you would actually use a decimal. So 0.5 and then 1, 2, 3. So n would be 3.5. And again, look at the examples and you will understand what I'm talking about. Next, we talk about matrix pricing. If the market price for a bond is not available, estimate the market discount rate and price based on the quoted or flat prices of more frequently traded comparable bonds. These comparable bonds have similar times to maturity, coupon rates and credit quality. Now I won't do this in detail, but the idea is that you interpolate. Let's say that you need to find the price of this bond, bond X, which is a 3-year bond and a 4% coupon. Now this might not be traded often, so you look at these other bonds, a 2-year bond with 3% coupon. So you can find, as in let's say you know the YTM and the price for that, you know the YTM and price for this. So based on these two numbers, can you figure out this number? You can interpolate and say that for a 2-year bond with a 4% coupon, what would the price be? And then you use the other data given also and interpolate and eventually end up with the price and YTM of bond X. So this process is called matrix pricing, and it is also briefly referenced in corporate finance, but the main thrust is here in fixed income. Matrix pricing is used when underwriting new bonds to get an estimate of the required yield spread over the benchmark rate. So when you issue a new bond or you are trying to figure out what the right yield is, you don't know because the bond is not in the market yet. So you look at other comparable bonds and use this process called matrix pricing to come up with the relevant price and yield. Yield measures for fixed rate bonds. consider a 5-year zero coupon bond priced at 80 per 100 par value. What is the stated annual rate for periodicity equal to 4? And then there are two other periodicities. This material connects with what you've seen in quantitative methods. So what does periodicity equal to 4 mean? This means that you are assuming 4 periods in a year. Okay. Now these numbers are given. You are told it's a 5-year zero coupon bond. So essentially 0, and then if the periodicity is 4, then in a 5-year period, how many periods do you have? You have 5 times 4, which is 20. You have 5 times 4, which is 20. PV is minus 80, payment is 0 because this is zero coupon. FV is 100, and you compute the interest rate 1.12. This is 1.12 for a quarter. So 1 period, which is 1 quarter. And then you need to annualize by multiplying by 4, and you get 4.48. So this is your stated rate with a periodicity of 4. What if periodicity is 2? And this is important because most bonds have a periodicity of 2. Then N becomes 10. And using the same sort of calculation, you have a stated rate of 5.41. So notice this number has gone up. So a stated rate of 4.51 with a periodicity of 2 is equivalent to a stated rate of 4.48, which is a lower number, but at a periodicity of 4. What if the periodicity is 1? Then N becomes 5, and the stated rate is 4.56. This stated rate is also the effective annual rate, because if 80 is becoming 100 over 5 years, then the effective rate every year is 4.56. Now back up to this point, 4.51 is the semi-annual bond equivalent yield. Remember, when we talk about bond equivalent yield for a bond that makes 2 payments a year, we find the rate for a 6-month period and double it. And that's what's happening here. More on yield measures, and here I've highlighted some of the important items. If you think about the yield measure on a bond, we've talked about the concept of IRR. So you need to know the cash flows, and you need to know when those cash flows are happening. So when a bond is issued, there are specific dates on the schedule, and at least according to the schedule, the cash is paid on those dates. But what if those dates fall on holidays or weekends? Then the actual money is received immediately after the weekend or after the holiday. When we talk about the street convention ignores the fact that money is not paid on weekends and holidays. It just assumes that the payment is made on whatever the scheduled date is. The true yield calculates the yield assuming that the payment is made on the appropriate day. In other words, that if a payment is supposed to be made on a Sunday, the street convention will assume that it's made on a Sunday, but the true yield will assume that it's made on the Monday, which is when the payment is truly made. But the convention is to use the street convention. That's what's normally used. The difference between street and true yield is very, very minor. So street convention is what we generally go with. Government equivalent yield is where you take a corporate bond and restate based on 30-360 convention, because government instruments are generally quoted based on a 30-360 convention. Yield to first call means that if you invest in a callable bond, then you assume that the bond will be called at the first opportunity. If the bond is called at the first opportunity, then what's the yield? That yield is called the yield to first call. Similarly, if you assume that the bond is called on the second call date or the second opportunity, that's the yield to second call. Let's say a bond is also puttable. So you calculate the YTM, the yield to first call, yield to second call, yield to put, and then the worst yield is called the yield to worst. Option adjusted price is where a bond has an option, And obviously the price of the bond is impacted by the option. We've talked about the fact that if a bond has a call option, does that increase the price or decrease the price? With a call option, the price goes lower. Option adjusted price means that you take a price which would be the price if the option were removed. So that is option adjusted. And an option adjusted yield is the yield with the option removed. Okay, simplified FRN pricing model. So I like this word simplified because you look at this and there's nothing simple about what you are looking at, or it doesn't appear simple. Those quotes, by the way, are mine. The simplified FRN pricing model is what the curriculum calls this. What I'm going to demonstrate is that this actually is not as bad as it looks, and then on the next slide I'll give you a simple question or a simple example from the curriculum. First point to note is that with this model we make some assumptions. That the present value is for a rate reset date. In other words, if you have, let's say, a bond which has 4 periods, so 0, 1, 2, 3, 4, each period, let's say, is a 6-month period. So we are doing the pricing on these reset dates because with a floating rate security, we reset on these particular dates. All right. Next, now just a few things to keep in mind. The present value is simply the present value of all future cash flows. So the principle we are going to use is the same. We are going to find all these cash flows and then discount back. Since this is a floating rate note, obviously the cash flow will depend on the reference rate at the start. These numerators that you are seeing are the cash flows. So index refers to your benchmark. Let's say that your index is LIBOR, and let's say that at time 0 LIBOR was 5%, so that's 5%. Quoted margin is the margin that is quoted for that floating rate note. Let's say a floating rate note is issued where that quoted margin is 3%. I'm just picking numbers here. So the index plus the quoted margin becomes 8% into the face value. Let's say face value is 100. So you have 8% into 100, which is your regular calculation of a coupon, and then divided by M. M is the periodicity. So if this is paying coupon twice a year, then what is M? It's 2. So what does the cash flow become? It becomes 8% of 100 and then divided by 2, so 4%. So all this complicated looking thing boils down to is a cash flow of 4. Right? Similarly, over here, so all these numerators are the same. The last one also includes the face value because, as you know, the face value of 100 is also paid in addition to the final cash flow. So the numerators are straightforward. You also need to discount all the cash flows, and there again the logic is the same. You discount each payment at 1 plus the interest rate. Interest rate is again index, which is LIBOR, plus the discount margin. So let's say the discount margin is 2%. So you take index plus 2% divided by M, which is 2, the periodicity. So that's all we are doing. We are just discounting back. All right, let's look at an example which illustrates a simple way of solving problems like this. And this is a question that someone asked. You are evaluating a 3-year floating rate note which pays 6-month CIBOR plus 200 basis points. CIBOR is Karachi Interbank Offer Rate. It is analogous to LIBOR. This security is priced at 95 per 100 par. Current 6-month CIBOR is 10% and assume a 33-60-day convention and evenly spaced periods. What is the discount margin? So from our previous slide, we are trying to find the discount margin. So this is a short way or a quick way of answering a question like this. If you look at the explanation in the curriculum on a similar question, that is extremely long. But you know that the present value is 95, so you set minus 95. You know that the floating rate is CIBOR plus 200 basis points, and you are told CIBOR is 10%. So 10% plus 200 basis points is 12%. Periodicity is 2. So you have 6%. So the cash flow is 6 for all periods. All right. Now, what do you plug into your calculator? So you plug in PV is -95, N is 6, payment is also 6, FV is 100, and you compute the interest rate, which is 7%. But this is the interest rate for a period. So you then double that and you get 14.1. So 14.1 is the discount rate being used to come up with a price of 95. But the question asks for the discount margin. The discount margin is the amount above the reference rate of 10%. So you do 14.1 minus 10%, which is 4.1%. In basis points, that would be 410 basis points. Yield measures for money market instruments. Money market instruments are short-term debt securities. They range in time to maturity from overnight sale and repurchase agreements, or repos, to 1-year bank certificates of deposit. Money market instruments also include commercial paper, government issues of less than 1 year, bankers' acceptances, and time deposits based on such indices as LIBOR and Euribor. So here we look at a high-level distinction between bond market yields and money market yield. So when we talk about bond markets here, we are referring to instruments with a maturity of more than 1 year. These are annualized and compounded. So what does that mean? Annualized simply means that when you say the YTM is 10%, that is referring to a year. If you take a 5-year instrument, then you are doing compounded. Calculated using standard time value of money analysis. So when we do a present value analysis, we are doing standard time value of money, and stated for a common periodicity for all times to maturity. With bonds, generally the periodicity is 2 or 2 periods per year. What about money market yields? These are annualized and stated on a simple interest basis. In other words, if you have a rate for, let's say, an instrument that is maturing in 30 days, then what you will do is multiply this. If you have a 30-day rate, then to annualize, what will you do? You will simply multiply by 360 over 30. So stated on a simple interest basis. No standard calculation. You can have discount, so you can have a rate based on a discount basis or add-on basis. And instruments with different times to maturity have different periodicities for the annual rate. It is important to understand the distinction between discount basis and add-on, and we'll just do a couple of quick calculations. Suppose that a 91-day T-bill with a face value of 10 million is quoted at a discount rate of 2.25%. Now remember, with a discount instrument, so a T-bill is quoted on a discount basis, right? For an assumed 360-day year, say FV is 10 million, days 91, what is the price of this instrument given a discount rate of 0.0225 or 2.25%? You use this formula that you've seen in quant and you've seen in corporate finance and you're seeing here, and you are almost certain to see it on your exam. So plug and play. Discount rate is 0.0225, and then year 360 over days 91 into D. What does this D stand for? It's the discount. So you just calculate the D, and then how do you come up with the value of the bond? It's 10 million minus this number, which should be this number. In the regular course, we make you do the working, but in the crash course, I'm just giving you the answers. Those who are looking at the video should pause and make sure that you can get these answers. Suppose that a Canadian pension fund buys a 180-day banker's acceptance with a quoted add-on rate. So now this is an add-on rate for a 365-day year. If the initial principal amount is 10 million, what is the redemption amount at maturity? That means how much will be returned at maturity. So with add-on rate, the key distinction is that here in the denominator we have the present value or the investment amount, whereas with the discount rate basis in the denominator here we have the face value or the final amount. So you plug in the numbers given and you come up with the interest amount of 219,000, and the redemption amount then is 10 million plus 219,000. Maturity structure of interest rates. We've talked about spot rates, and here we'll just get into a little more detail. The spot rate curve plots different maturities on the x-axis and corresponding spot rates on the y-axis. Spot rates are yields to maturity or return earned on zero coupon bonds maturing at the date of each cash flow, if the bond is held to maturity. The spot rate curve is also called the zero or strip curve. So here you have maturities on the x-axis. So you can have a 1-year maturity, 2-year maturity, 3-year maturity, and so on. And then on the y-axis you have the spot rate. So if the annualized rate on a 1-year instrument is 10%, 2-year instrument is 11%, 3-year instrument is say 11.5%, these are all annualized numbers. Then what we are plotting here is the spot rate curve. Next is the yield curve. The yield curve plots yields of bonds. So notice these are yields, not spot rates. Yields of bonds on the y-axis versus maturity on the x-axis. The main difference between a yield curve and a spot rate curve is that the yield curve considers the coupon payments as well. Obviously with the spot rate we are considering zero coupon bonds, so there are no intermediate cash flows. The assumption in a spot rate curve is that there are no intermediate coupon payments. So you will also, in addition to the spot rate curve, it's much more common to see a yield curve. So if this is your yield curve, then it's saying that on the 1-year instrument the yield is this, on a 2-year instrument the yield is this, and so on. The par curve plots yield to maturity for different maturities, but the bonds are assumed to be priced at par. They also have the same currency, credit risk, tax status, liquidity, periodicity, etc. So I would say that you just learn this. Forward curve and spot rate. So we've talked about forward rates, we've talked about we've talked about spot rates, and we've talked about yield. Now we are also going to talk about forward rates. This is something you see here, and you will also see this in derivatives. A forward rate is the interest rate on money borrowed in the future. Forward rates are generally written in this format, 2y, 1y. This is the rate on a 1-year loan starting 2 years from today. So the first 2 is saying that you are going to borrow after 2 years. So you go to your bank and you say that after 2 years I'll borrow, and I will borrow for 1 year. What is the rate? Essentially you are asking for a forward rate, so a borrowing in the future. What you need to be able to do from an exam perspective is calculate these implied forward rates given some other rates. So say the 3-year spot rate is 10%. So here you are at time 0, and you are told on your exam question that the 3-year spot rate is 10%. So if you invest $1 here for 3 years, how much will you have at the end of 3 years? 1.1 Q. And you are told that the 2-year spot rate, so if you invest $1 here and you lock it in for 2 years, how much will you have at the end? Given a 9% spot rate, you will have 1.09 squared. What we are trying to find is this implied forward rate over here. So what is the rate on borrowing after 2 years for a 1-year period? So the concept behind this calculation is that the 2 strategies shown here should give you the same result at the end. And what are the 2 strategies? Strategy 1 is investing $1 for 3 years, $1 for 3 years, versus investing $1 for 2 years, ending up with 1.09 squared, and taking that money and investing at this forward rate for a year. So that's shown over here, 1.09 squared into 1 plus the forward rate. You calculate the forward rate and you get 0.19. You calculate the forward rate and you get 0.12, which is 12%. Why is this called the implied forward rate? It is called the implied rate because this is the rate implied by the other two rates that have been given to you. Okay, now what are some uses of these forward rates? Using forward rates, can you calculate spot rates? So if you are given this rate 1.88, which essentially is the 1 year spot rate, and you are given 1y, 1y, what does that mean? This is after 1 year. If you borrow for a year, then you get this. So can you get the 2 year spot rate? The 2 year spot rate is the geometric mean of 1.88 and 2.11. So you do 1 plus 0.0118 times 1.0277 raised to the power of 1 over 2. So this is called geometric linking. So given forward rates, you can get spot rates. And then can you use those spot rates to price a bond? We've already talked about that fact that you can use the spot rates to then calculate the value of a bond. So we can then say that using these forward rates, we can come up with the no arbitrage price of a bond. We are getting close to the end of this rather long reading. Yield spreads. So these are some of the important yield spreads. When we say benchmark spread, this is the yield spread over a specific benchmark such as LIBOR or Treasury bond yield. And these are the two most important references. In fact, these days what is becoming particularly important is LIBOR. So when we say that a particular bond is LIBOR plus 200 basis points, what does that mean? The benchmark is LIBOR and the spread is 200 basis points or 2%. So this is one important point. Now this 200 basis points can also be thought of as the risk premium when the reference rate is a government rate. So if the reference rate is, say, a 6-month T-bill, US government T-bill, then the spread or the amount above that, so say the 6-month T-bill rate, let's say, is 4%, and a particular instrument is trading at 6%, so what's the risk premium? It is 2%. That 2% can be broken into a few components. Those components are shown right here: the taxation component, liquidity component, and credit risk component. So credit risk means that there is a risk of default, which is what we'll talk about later. If the credit risk is high, then the spread increases. If the liquidity is low, then the spread increases. So those are the main points. Taxation is not hugely important, but the way you can think of it is that if the taxation is having an adverse impact, then obviously that also contributes. But I'd say from a testability perspective, the two big ones are liquidity and credit risk. Later we'll also talk about options, but I'll make one more point over here. When we talk about the T-bill rate of 4%, this is a nominal rate. The nominal rate has two components: expected inflation and the real rate. So this goes back to a simple relationship that we talked about, that the nominal rate is approximately equal to the real rate plus expected inflation. So these are the important points covered here. A G spread, G stands for government. This is the yield spread over an actual or interpolated government bond. So in this scenario over here, where I said that this 4% is a T-bill rate, then the spread over it is really a G spread because it's a spread over a government bond rate. I don't think I spread is overly important, but just remember it. I spread refers to the yield spread over the standard swap rate. A Z spread or a zero volatility spread is based on the entire benchmark spot curve. It is the constant spread that is added to each spot rate such that the present value of the cash flows matches the price of the bond. Now this is a little bit complicated. I'd say that at this stage you simply remember the statement, and there is a good chance that if you get something on the exam, it can be answered based on this statement. Another term that you need to know is option adjusted spread. An option adjusted spread on a callable bond is the Z spread minus the theoretical value of the embedded call option. So all you are saying is the following. If you think about a callable bond, then you as an investor will demand a higher yield or higher return because of that call option. If you remove the impact of the call option, then the yield comes down. And the yield with the impact of the call option removed is called an option adjusted spread. In finance, generally when we say adjusted, so inflation adjusted or option adjusted, that means that the impact of that thing is removed. So when we talk about a real rate, it's also called inflation adjusted, which means inflation is removed. When we say option adjusted, that means that the impact of the option is removed.